You look at the screen. The balance is $40 million. It sits in a demand deposit, supreme liquidity. This is the base layer, the foundation. The global economy does not function without it. You deploy it in seconds. A keystroke clears a payroll in Tokyo. A wire settles a trade in London. The gears spin because this capital moves without friction. You do not leave it idle. Idle cash is a liability. You buy treasury bills, 90 days sovereign debt, absolute safety, backed by the taxing authority of a state. You buy commercial paper, short-term corporate obligations. You fund the daily inventory of a multinational conglomerate. You enter the repo market. You exchange cash for collateral overnight. The next morning, the transaction reverses. You collect a fraction of a basis point. You do it again. Trillions move this way every night. There's zero market risk here. No volatility, no drawdowns. The principal is secure. When equity markets collapse, this is where the capital hides. It is absolute safety. But the safety is an illusion. You look at the macroeconomic data. The inflation print is 3.4%. Your blended yield is 2.1%. You are losing money. It is a silent theft. The central bank cannot touch this capital, but the central bank can. The printing press dilutes it by the hour. You hold the safest asset on earth, and it mathematically guarantees a loss of purchasing power over time. You trade purchasing power for immediate access. You pay the hidden tax for the privilege of standing still. You accept the terms. There is no alternative at this level. You press execute. You move up the capital structure. You enter the debt markets. The mechanism is simple. The time value of money. You are buying the future. You price sovereign bonds. You fund a 10-year highway project. You underwrite municipal debt for a school district. You structure investment-grade corporate bonds to build a semiconductor plant. This is the architecture of civilization. You trade current capital for future yield. You lock in 5.4% for a decade. Cash flows are contractual. The payouts are predictable. The stability is engineered. You sleep well because the math is guaranteed by the state or the corporate balance sheet. But you know what debt actually is. It is leverage. It is a legally binding claim on human effort that has not yet occurred. You are pulling tomorrow's labor into today's consumption. A sovereign issues a 30-year bond. A generation not yet born will pay the coupon. You look at a syndicated bank loan, high yield, covenant light. The corporate balance sheet is suffocating. The debt-to-EBITDA ratio hits 7. The interest coverage ratio collapses. The leverage compounds. The yield curve inverts. The refinancing window closes. The corporation defaults. The sovereign restructures. You mark down the position. You hedge the exposure. You survive. The middle class does not. Their pensions hold the paper you just dumped. The economy fractures under the crushing weight of the leverage. You do not fix the fracture. You do not feel the layoffs. You just recalculate the recovery rate. You wait for the distress cycle to peak. You buy the debt back at 40 cents on the dollar. The future is auctioned off at a discount. You place your bid. You move on. You enter a ticker symbol. You press buy. You no longer hold a promise to be repaid. You hold equity, ownership. This is the greatest wealth creation engine in human history. You buy a fraction of a server farm in Virginia. You buy a sliver of a pharmaceutical patent. You own a microscopic piece of a logistics network spanning 2 continents. You do not build the infrastructure. You do not manage the payroll. You supply the capital. The corporation executes the labor. The market compounds the return. You buy an ETF. You buy the entire index. You capture the aggregate growth of human innovation. The earnings compound. The dividend clears. Your wealth scales independently of your time.
Then the screen flashes red, the manic phase ends, the depressive phase begins. The fundamentals have not changed. The servers are still running, the logistics network is still delivering, but the price collapses. It drops 14% in 2 hours. Valuations completely detach from reality. Fear replaces arithmetic. High-frequency algorithms take control. They execute 10,000 trades a millisecond. They hunt for stop losses. They front-run the panic. Momentum cascades downward. Support levels break. You watch the volume spike. Retail accounts liquidate. The general public logs in and bleeds out. They panic. They sell at the exact bottom. They capitulate. They transfer their fractional ownership to the institutions waiting patiently on the other side of the spread. You do not sell. You understand the mechanism. The price on the screen is not the value of the underlying asset. It is merely a real-time aggregate of human panic and algorithmic momentum. You wait for the volume to exhaust itself. You wait for the retail margin calls to finish. You buy their capitulation at a 40% discount. You close the terminal. You wait for the mania to return. You are no longer buying a single loan. You are practicing financial alchemy. You take illiquid debt, thousands of mortgages, auto loans, credit card balances, and you pool them together. A bank issues a mortgage to a family in Ohio. The bank does not want to wait 30 years for the yield. You buy the loan. You package it with 10,000 others. You slice the pool into tranches based on risk. You sell the cash flows to pension funds in Tokyo and sovereign wealth in Oslo. You clear the bank's balance sheet. The bank makes another loan. The average worker gets a car. The family gets a house. You democratize credit. You fund the expansion of the middle class. Then you optimize. The architecture gets heavier. You securitize the securitizations, collateralized debt obligations, CLOs, synthetic CDOs backed by credit derivatives. You construct paper on top of paper. You build a tower. The math becomes impenetrable. The rating agencies bless the senior tranches with AAA stamps because the models say the risk is diversified. The models are wrong. The diversification is an illusion. The obfuscation is total. No one understands what they actually hold. You do not know the family in Ohio. You only know the yield. Then the underlying foundation rots. A borrower defaults. Then 10,000. The rot climbs the tranches. The alchemy reverses. Toxic debt infects the supposedly pristine paper. The contagion does not stay localized. It travels through the wiring of the global financial system. The year is 2008. The credit markets freeze. The tower collapses and crushes the global economy. The middle class loses the houses you funded. You do not go to prison. You just recalibrate the model. You start again. You stop buying assets. You buy the ghost of the asset. You trade the derivative. You trade the price movement without owning the underlying physical reality. You are the CFO of a global airline. Jet fuel is volatile. A 10% spike bankrupts your quarter. You cannot control geopolitics. You cannot control refinery capacity, but you can control your exposure. You enter a futures contract. You lock in the price of fuel for 18 months. The spot price of crude fluctuates. Your balance sheet does not. The consumer buys a ticket at a stable price. You successfully transfer your risk to the market. The utility is undeniable. But risk does not evaporate. It merely relocates. You discover this secondary function of the derivative, leverage. You construct an option spread. You execute an interest rate swap. You no longer need $100 million to control $100 million of exposure. You need $5 million. You control massive notional value with a fraction of the capital. You sell naked puts. You sell unhedged volatility. You collect the premium. It looks like free yield. You engineer synthetic returns. Then the tail risk materializes. A central bank surprises the market. A currency depegs. The underlying asset drops 12%. Your derivative position does not drop 12%. It implodes entirely. The math is nonlinear. The leverage reverses. Your downside is not capped at your initial investment. Your margin account evaporates in 4 seconds. The automated risk engine liquidates your portfolio at market price. The clearinghouse issues a margin call. They demand a wire by 8 a.m. You do not just lose what you have. You owe what you do not possess. You traded a weapon of mass financial destruction. You were holding it when it detonated.
You do not buy pure debt. You do not buy pure equity. You buy the shapeshifter. You purchase the convertible bond. On day one, it is a liability on the issuer's balance sheet. It pays a fixed coupon. You have downside protection. You sit above the equity holders in the capital structure. The company secures cheaper funding. The interest rate is discounted because you accepted the embedded option. Then the underlying stock surges. The mechanism activates. You execute your right. You surrender the paper. You receive common shares. You are no longer a creditor. You are an owner. You capture the upside. It is maximum flexibility. You bought a safety net that transforms into a growth engine when the conditions align. That is the pitch. The reality is structurally different. You read the offering memorandum, 140 pages of legal architecture. The complexity is deeply asymmetric. The issuer built the arena. They wrote the rules. You analyze the conversion premium. You map the soft call provisions. If the equity performs too well, the company forces an early conversion. They cap your return. If the balance sheet deteriorates, you discover your capital notes are heavily subordinated. You are wiped out before the senior secured debt even registers a loss. There are mandatory trigger events, knock-in barriers, equity-linked notes with exotic options buried in the footnotes. The math is intentionally dense. It is designed to extract value from the unsophisticated. The average buyer sees the high yield and the equity upside. They do not price the embedded optionality. They do not read the fine print. You price it. You strip the bond. You model the option. You locate the exact threshold where the issuer holds the advantage. You only buy the shapeshifter when you control the transformation.
You leave the public markets. The ticker tape is gone. You operate behind closed doors. You no longer trade fractions of shares. You buy entire companies. You dictate terms away from the scrutiny of quarterly earnings. You deploy private capital. You manage venture capital. You find 3 engineers with a prototype. You write a $10 million check for 30% of a company that barely exists. 9 investments go to 0. The 10th becomes a global platform. You fund the absolute frontier of human innovation. You shift to private equity. You find a bloated, decaying industrial supplier. You buy it. You fire the board. You force efficiency. You make the structural guts the public markets lack the stomach to execute. You salvage the core operation. But efficiency is a sterile word for extraction. You execute a leveraged buyout of a regional hospital network. You use the hospital's own balance sheet as the collateral to acquire them. You load the entity with $800 million in high-yield debt. You extract a $200 million special dividend on day 1. Your fund is immediately whole. You transfer the risk entirely to the target. You strip the real estate and lease it back to them at a premium. You slash the nursing staff by 20% to hit the mandated EBADA target. Language functions as insulation. You call it right-sizing. The margins improve on paper. You sell the hollowed-out shell to another sponsor for 3 times multiple. The hospital files for bankruptcy 3 years later. The community absorbs the loss. You do not read the local news. You hunt for structural weakness. You extract the marrow. You report the internal rate of return. The doors remain locked.
You step away from the screens. You leave the paper and the code. You buy the physical earth. You acquire things you can touch, build on, or burn. A fiat currency collapses. An equity market evaporates. A derivatives tower falls. It does not matter here. You own a port in Rotterdam. You own a grain elevator in Kansas. You own a copper mine in Chile. This is the ultimate hedge. Gold sits in a vault, entirely indifferent to central bank policy. Crude oil flows through a pipeline. Commercial real estate houses the corporate machine. You own the infrastructure of human existence. These assets do not require a collective belief system to hold value. They possess intrinsic gravity. They feed nations. They power cities. They house the population. But the gravity is heavy. The capital requirement is massive. The liquidity is zero. You cannot liquidate a hydroelectric dam in an afternoon. Because you own what everyone desperately needs, you are a target. You are politically vulnerable. A sovereign government nationalizes your lithium mine. A geopolitical conflict severs your natural gas supply chain. A local regulatory board caps the rent on your residential towers. You control essential human needs. That control carries a permanent moral weight. When a regional power grid fails, your pipeline dictates who freezes. When global crop yields drop, your farmland dictates who eats. You do not model the human cost. You simply price the scarcity. You secure the physical perimeter. You extract the yield. You hold the ground. You disconnect from the legacy system. You trust math, not men. Decentralized trust. You buy Bitcoin. It exists on a ledger distributed across 10,000 nodes. No central bank can print more. No government can freeze the address. You transferred $10 million to Buenos Aires at 3 in the morning. No intermediary asks for permission. No compliance officer flags the wire. The transaction clears in 10 minutes. For a citizen trapped in a hyperinflationary economy, this is not speculation. It is a lifeboat. It is a mathematical exit strategy from a corrupt state. You step further out. You enter DeFi. You lend synthetic stablecoins to a smart contract. No bank extracts a spread. The code executes. It is borderless, permissionless yield. But the code is merciless. This is the frontier. There is no deposit insurance here. There is no customer service hotline to reverse a transaction. You hold your own private keys. You are your own bank. That is the promise. It is also the trap. The volatility is violent. Your net worth drops 40% in a weekend. The ecosystem is flooded with grifters. They launch unregulated tokens, inflate the liquidity pool, and drain the reserves in the dark. A smart contract you trusted contains a single logic flaw. A hacker finds it. The protocol is drained in 12 seconds. The anonymous developer vanishes. Your yield evaporates. Or worse, you simply make a human error. You lose the hardware wallet. You forget the 12-word seed phrase. The blockchain does not care. Code is law. The exact cryptography that half the state out now locks you out. Your wealth sits permanently visible on the public ledger. You can see the balance. You can never touch it again. You leave the traditional markets entirely. Equities correlate. Debt correlates. You seek uncorrelated alpha. You stop betting on economic cycles. You start betting on specific human events. You enter litigation finance. A municipality is suing a chemical conglomerate. The municipality is out of capital. The conglomerate is stalling. You step in. You fund the plaintiffs. You do not care about the chemicals in the water. You care about the settlement. You buy a percentage of the final judgment. You provide the capital to survive the legal attrition. You make the lawsuit possible. You buy catastrophe bonds, insurance-linked securities. A reinsurance vehicle needs liquidity to cover a potential Category 5 hurricane in Florida. You provide the capital. If the wind stays below 150 miles per hour, you collect a massive yield. If the wind hits 155, your principal is wiped out. It goes to rebuild the city. You provide the ultimate structural safety net. You buy royalty streams, the future revenue of a pharmaceutical patent. You turn human sickness into a fixed income instrument, then the moral architecture warps. You realize what uncorrelated alpha actually requires. You are financially incentivized by human friction. You check the radar during hurricane season. You are not checking for the safety of the coastal residents. You are tracking the barometric pressure. You are calculating the exact moment your principal evaporates. You sit in a boardroom and calculate the lifespan of an injured plaintiff. If they die before the trial concludes, the settlement drops. You need them to live exactly long enough to collect the judgment. You do not hope for a stable world. A stable world yields 4%. You hunt for friction. You price the disaster. You collect the premium.